Good afternoon, friends. In the subject of fundamental of investment, in my previous lecture, I talked about derivatives. Means what we discussed in the previous lecture was what is derivative, what are the different types of derivatives, who are the participants of derivative. If you recollect, in the previous lecture, I said derivative is like a contract which takes place between the two parties, and the value of the derivative depends on the value of the underlying assets. The asset may be, because there are different type of derivative like commodity derivative, financial derivative. When I talk of the commodity derivative, it means the derivative of silver, gold, all these commodities, and it can be of grains, wheat, rice, these the different type of commodities which are prevalent, for which the derivative market is present internationally. And similarly, there can be financial derivatives. Financial derivatives may be of stock, it may be of index, means the index of different stock exchanges, it may be for the interest rate, right? So these are the different type of financial derivative, interest rate, exchange rate, these are the financial derivatives which we talk of. And then you can talk of the simple derivatives, complex derivatives, forwards, future. There are different type of derivatives that takes place. We'll be talking in detail. And the parties who are interested, the participants, they may be hedgers, they may be speculators, they may be arbitrageurs. So these are the various issues which were discussed in our previous, which I talked about in my previous lecture on the derivative. And I also talked about, when I was saying about talking about the types of financial derivatives, I talked in length about the forwards. Forward is basically a contract between two parties, which is OTC contract. It is a personal contract between the two parties for purchase and sale of any real or financial asset at a specified price at a specified time on a future date, right? So this is basically the forward. So in today's lecture, I'll be talking about the future. That is what we mean by future. I would say that future is a refined version of the forward. What do you mean by refined version? In the forward, like forward, I'm taking from my previous lecture that like forward, it's also a contract between the two parties for buying and selling of a real asset, means the commodities, or it may be the financial asset at a future date at an agreed price and of a particular quantity, right? What is that means is that basically when I'm talking of the forward market or the forward, it's a OTC contract. It is an individual contract between the two parties where the quantity is not being specified, depends on the agreement between the two parties. The date is also agreed upon by the two parties. I'll be referring in detail when we'll be talking of the difference between the future and the forwards. But what it is, basically the main feature of the future is, as compared to the forward, is that it is exchange traded contracts. So it is a contractual agreement between the parties to buy and sell a particular asset in future for a particular price on particular date. So what you are seeing, that if you go by this words of the what we mean by future, it's an agreement between the two parties, right, to buy or sell a particular asset. As I just said, the asset may be the real asset, it may be gold, it may be silver, it may be grains, right? Or it may be financial assets, like it may be index, it may be stock, it may be interest rate, it may be the exchange rate, right? So the underlying asset is something, because in the derivative market there is some underlying asset. So underlying asset is a particular asset for which the future contract is being made at an agreed price. Today in the market, there may be a particular price. Say, for example, if I talk of a share, stock, that suppose the price of ABC Limited at present is 1,000 rupees. And you as a buyer, you are expecting that the price of this stock will increase. And in the future market, the price is 1,010 rupee. So what you can do is, you can buy this stock at 1,000 rupees by paying a premium, right? So of a particular price, the agreed price is 1,010, that in future market, that I'll be buying this asset at 1010 rupees of that particular stock of a particular company, you will buy at 1010. Some other party which is expecting that the price may not increase or rather it may fall. So it will sell that at 1010 rupees. It is expecting that the price will not increase, price will rather fall, right? So it will sell that asset that stock at 1010 rupee. So at an agreed price of 1010 rupees, a contract has been formed on a particular day, right? Means if I talk of today and if the expiry is on a particular date, that is 1 month from now, so on that date the transaction will be transacted either by physical transfer of that asset or by paying the difference of the amount to the buyer and the seller, means as the case may be, right? So it's a 3-4 things which you are seeing is an agreement to buy and sell, a particular asset is involved, a particular price, means predetermined price is involved, and on a particular date. So this agreement is called future. It is a standard forward contract which is traded on an exchange. The main difference between the future and the forward is that this contract, unlike in the forward market which is a OTC contract, it is a contract which takes place through exchanges. Like for example, if I talk of financial asset, if I talk of say for example stock in the index, it is in India there are two important exchanges, BSE and NSE. So this future market means that future contract will take place on either BSE or the NSE. If I talk of commodity market, means if you are talking of the gold, silver or any other commodity, right, it will be dealt, means the contract will be through the MCX or NCDEX, right. So for commodities, these are the two important exchanges in India. What it means is that this contract will be through an exchange. The future contracts will take place through an exchange. It is an obligation and the investor is bound to fulfill it even if the asset price is not favorable on the settlement day. Unlike in the forward contract, where the agreement is between the two parties and then either of the party if defaults, then it will have to go to the court of law for getting the contract enforced. But in this case, in case of future, the obligation of fulfilling the contract means that buyer or seller, the guarantee is being given on behalf of the buyer and seller by the exchange through clearing houses, right. So exchange will ensure that both the parties fulfill their obligation. So your risk is being minimized because the exchange is involved in it. Like if I talk of the stock future, the stock future, if I am dealing with the National Stock Exchange, which is called popularly known as NSE, it is the NSE which is bound to get my order fulfilled or got my contract, the future contract implemented. What it means is that the obligation for fulfilling the contract, the counterparty guarantee is being given by the exchanges for the fulfillment of the contract. The terms of the future contracts are standardized by the exchanges with reference to the quantity, date, unit of price quotation, the minimum change in price, etc. See, when I am talking of the future contracts, it is the contract size is being fixed by the exchanges. Let me talk of a specific share, like say for example State Bank of India, which is the largest public sector bank in India. In future market, each transaction, each future contract is of minimally 1500 shares, right. So if you want to deal, you want to buy or sell the State Bank of India share in the future market, the quantity is fixed, that is 1500. Each lot, we call it lot, each lot is of 1500 share. And these contracts are of a particular period, 1 month, 2 months, 3 months, like that. So normally in India, the last Thursday of every month is the expiry day or expiry date of the contract. So last Thursday means if it is a holiday, then the previous day of the last day, Thursday, is the expiry date. So the date is fixed. Say for example, if it is July, on July 28th, the last Thursday lies. It means on 28th the contract will has to be settled, set off, right? So date is fixed. Unit of price quotation. When I am saying unit of price quotation means the price at which the transaction, the contract will take place, and what will be the units of the price quotation, that is also being given, and the minimum change in the price. When I am saying minimum change in the price means that supposing the current price of the, or say for example the State Bank is 1500 rupees, and the buyer and the seller can quote the price at, say for example, if the exchange fixes a 50 paisa difference, so either you can quote 1500 50 paisa, 1500 1 rupee, 1500 1 rupee 50 paisa, like that. So minimum change in the price, that is called tick, is say 15 paisa. It's just an example. So the buyer or the seller, if you want to give a buying quotation, right, so you will give your quotation in the difference of 50 paisa price, right? Any price you want to give, but the price cannot be like say 1525 paisa or 1520 paisa. It cannot be like that. If exchange says that the exchange fixes that the minimum change in the price is of 50 paisa, then each share quotation which is being quoted by the buyer or the seller, as the case may be, will be in the difference of 50 paisa, right? So these things means the lot size, the date of fulfilling of the contract means setting of the contract, the price quotation, the difference in the price tick is all being determined by the exchanges, right? So any person who wants to make a contract in the future market, they will have to abide by the rules and regulations, or the size of the contract and the date and the price quotation of that is being determined by the exchanges. There is no counterparty risk, default risk, as the guarantee is given by the exchanges. Just now in a previous point I told you that unlike in the forward market, here in the future market there is a counterparty guarantee which is given by the exchanges. What it means is that exchanges ensures that both the parties fulfills the guarantee, and for that purpose exchanges keep margin. I'll be discussing the margin point later on, right? So means it is the responsibility, it is the duty of the exchanges to get the contract fulfilled, right, by both the parties. The main advantage of future is that it removes the uncertainty about the future price of an item, right? Means if I make a contract in the future market, right, so it means I am sure of getting, suppose I am buying, the same example if I take State Bank of India, if I am buying State Bank of India at 1510 rupees in the future market, I am sure that on the day of the expiry, whatever the price of the State Bank may be, right, it may be 1600, it may be 700, it may be 1400 also, it may be reverse also, right? I'll have to buy the State Bank at 1510 rupees, which is our predetermined price, and the seller will have to sell at 1510 rupee, even if the price goes to 1400 or 1600, whatever the price may be, seller will have to buy. But by and large, for your knowledge purposes, friends, normally most of the future market, most of the transactions are settled not by actually delivery of the shares or the stocks, but by paying the price difference. In the cash market means by paying the cash. When I use the word cash means through banking transactions, right? So by settling the difference in the price, the agreement is being made. Or if somebody wants to give, if a seller wants to give the share, the buyer will have to take the share, right? So but practically through delivery less transaction takes place, but it is being offset by the difference by paying the price. Suppose a company X knows that in 3 months it will have to buy 100 kg of silver. Now I'm taking of the commodity future, right? 100 kg of silver to fulfill the order means if you are a manufacturer, and for that manufacturing purposes you need silver, right? So you need 100 kg of silver for producing that thing. See the order. Assume the spot price of the silver is 60,000 rupees kg, and 3 months future price is 60,500. Means, because see, why you will ask me that why there is a difference between the current price and the future price. This difference is when market is bullish, when people are expecting that silver price will go up further, means the silver prices are going, right? As you are aware, these commodity prices are being influenced by the difference by the impact of the international prices. Means if the international prices goes up, the prices of the silver or the gold also goes up in the local market. If the price comes down, it is also being affected. Means they are internationally derived. These prices, the prices of the commodities, especially the gold, silver, metals, I will say, are not being determined by only by local market. They are being determined internationally, right? So international impact makes international market makes an impact on the local market. So when the market is going up, people are expecting the silver prices will go up at a very fast rate, and in the 3 months future price is 60,500 rupees. So what this manufacturer can do is that this manufacturer can buy 100 kg silver of 3 months future, because it will be needing the silver after 3 months, right? So it can buy the silver in future market at the rate of rupees 60,500 for 100 kg at the 60,500 kg per kg, and it buy 100 kg at the rate of 60,500. Now after 3 months, when the expiry time will come, whatever the price of silver may be, it may be 65,000 rupees, it may be 58,000 rupees. This buyer will get the silver at 60,500 rupees. Means this buyer is Mr. X is, sure that the buyer will get the silver at 60,500 rupees. Means what he has done is that the price is being fixed in advance, and the price, he is not worried about the fluctuation in the price. He is not worried about the changes in the price, because the price quotation which this manufacturer has made is on the basis of presuming that the cost of the silver will be 60,500 rupees, and keeping 60,500 rupees silver price per kg, right? The prices has been further quoted for the finished product, right? So after talking about the different things on the basis of whatever the discussion we have made so far, I can talk of the features of standardized future contract. So I'll brush up these quickly, because most of these points I have already talked about. So these are standardized contract. Standardized contract means, as I said when I was talking about this future contracts, that the size of the contract, like the example which I took of State Bank of India, each contract is of 1500 shares. So it means the quantity is fixed, the rate is predetermined, the expiry date is fixed, the tick price is fixed in the sense that the quotations can be made in a 50 paisa difference. So the contract is standardized. Unlike in the forward market, where the contract is not being standardized, in the future market the contracts are standardized. Exchange based trading means these contracts are through particular exchange. Like I said, in case of the, say, stocks, in case of the index, it is through NSE, BSE. In case of India, in the commodities, the two important exchanges are MCX, NCDX, like that. So these are exchange traded trading. No counterparty risk means the exchange, because these are exchange traded based trading. So exchange take the guarantee of getting the contract fulfilled, means for implementation of the contract. So there is no default risk in case of the future contract. Highly liquid contracts. These are highly liquid contract because although there is a fixed expiry date, means at the expiry, but since the quantity, the trade in the future market is very large, because of the large contract involved, large buying and selling involved. So on a day-to-day basis, on any working day of the exchange, you can set off the contract, right? Because there, if you're a buyer, somebody else will be seller of the end of the month. Earlier I was saying that there is an expiry date. The same seller who is selling the particular stock will sell of the same expiry, right? So it is not a contract between the two parties. You are a buyer, the other one is a seller. Whosoever may be the buyer, whosoever is seller, you are indifferent. You are dealing through exchanges. So anytime if you want to set off your contract, before the expiry also, the contract can be set off. So we say it is a highly liquid contract. Anytime you can set off the contract, that's why it becomes quite liquid. Margin requirement. This is very important, friends. I was just saying that there is no counterparty risk there is no default risk, right? Each party is under obligation to fulfill the contract, and exchanges ensures that the contract is being fulfilled. In order to ensure that the contract is being fulfilled, what the exchanges do, that at the time of contract itself, they keep a margin with itself. Suppose I want to buy the State Bank of India, my example which I took earlier, right? I want to make a future contract of the State Bank of India, right? So as I was saying that 1500 is the size of each contract. 1500 shares is the one lot, and the 1500 is the price. So 1500 is the price of the State Bank of India multiplied by 1500. It's just merely an example. It's not the exact, right? So whatever the value of the contract is, of that value, exchanges determine the margin of that contract size. Say for example, the margin is 10%. So at the time of the contract, the buyer and the seller, both the parties will have to keep 10%, which we call it initial margin, at the time of making the contract. Means 10% money has to be deposited to the exchanges through brokers, obviously, right, to the exchanges at the time of making the contract. And there is a mark to market on a day-to-day basis. I'll be taking an example and explaining you. Then on a mark to market basis, the margin is being kept. So there are two margins. One is called initial margin, which is being kept at the time of making the contract. The other is called mark to market margin, right? So if there is a large fluctuation in the stock prices, so the difference in the contract price and the current price and proportion of it is being kept as a margin with the exchanges, right? So that the risk default does not take place. So whenever future contracts are being made, the bottom line is, whenever the future contracts are being made, at the time of making the contract, both the parties will have to keep the margin, right? You may say like caution money, right? So I'm just a layman language, I would say, is the caution money, in the sense that some margin is being kept, and what will be the percentage of margin, that will be determined, that will be decided by the exchanges, and that depends on the level of fluctuation in the share. Suppose the fluctuation is low, normally there are certain shares where the fluctuation level is low, and the market is also going in such a phase where the market is not, means there is not ups and downs, large ups and downs in the market. So in that scenario, the margin percentage will be low. But if the nature of the stock, if the past behavior of the stock is such, when there is a very large variation in the prices, means that there is a too much fluctuation in the prices, in that sense the margin requirement increases. It is the exchange which decide that the margin of that on that particular share will be more. Before maturity, settlement is possible. As I was saying, it is a highly liquid contract. There is an expiry, but even before the expiry, you can set off the contract. So friends, these are the few features of the future contract. I'll be continuing with this future in my next lecture. Thank you very much.